Good afternoon. Welcome to the Forex Pro Charts weekly analysis for the week beginning May the 8th, 2011. And happy Mother's Day to all the mothers out there. This week we're going to look at the Euro JPY. And there are a couple of reasons I wanted to look at the EJ this week. One of them is that we just haven't looked at it for a while. Also, hopefully we'll be seeing some trade action on this pair in this coming week, so I wanted to prepare you for that. And also, there was a potential trade last week that we did not issue a trade alert on, and I did not include that. I neglected to include that in my results video, and so I wanted to go over that as well and show you why we did not post the trade alert. Now, I think after looking at all of the activity we had last week and the several trades that we had where we did not post a trade alert, that we are going to be doing something a little bit differently in the future. I think on our trade alerts, we are going to be posting alerts for both trades that we recommend and trades that we do not recommend. And when we do not recommend them, we are going to be explaining why and trying to indicate to you whether it is just a matter of risk aversion and that some of our more aggressive traders may wish to take that particular trade, or where it's a question of we just think it's a bad trade all the way around, no matter what your risk aversion is, even for aggressive traders. So be on the watch for that change in the upcoming weeks. You'll be probably seeing a few more alerts as we post trades that we do not recommend taking. And the reason for doing this is educational, so that you can more quickly learn why, when you want to take a trade and when you don't want to take a trade. The other reason is because as you demo, you may find that your risk tolerance is a little greater than ours. As I've mentioned before on those trade alerts, we try to be very conservative because we realize that many of our subscribers are fairly new to our system or even new to Forex trading, and so we want to be very careful with recommendations that we make for what you want to do, for what you're going to do with your money. So we have tended to be very conservative with that. This way, as we're posting all of the alerts, then you can evaluate our opinion and make your own decisions based on your own demo trading, your own trade plan, and your own risk tolerance. So the combination of the educational for the newer folks, and then also just to make folks who might be a little bit more aggressive aware when an opportunity comes up. Now, please realize that that while we make every attempt to post trade alerts for every potential trade as they come up, that we don't sit in front of our computer 24/7. We're like you, we're traders, and one of the reasons we trade is so that we don't have to be tied to something 24/7. And while we post alerts, set alarms to see when a trade is upcoming and that kind of thing, that there may be times that we are away from our computer if price is moving quickly or unexpectedly, or if we have something going on outside that may keep us away a little bit longer than we expected. There might be times that we miss an alert, miss a potential trade, and that's again why we encourage you. The trade alert is a service designed to help you, but we're certainly not trying to manage your account for you. We're not a managed account service, and so we're not guaranteeing that we're going to be posting and discussing every potential trade that comes up. We do the best we can, but again, we can't guarantee that. So, with all of that being said, let's go ahead and take a look at the EJ, and this, of course, is the monthly time frame. And you can see here that price was in a downtrend and then consolidated out and now has retraced somewhat. And so over certainly this month, which I believe was the nuclear reactor when we saw this, a strong move up in the EJ that particular month. And so we're wondering, some of you may be wondering, is the EJ now in an uptrend? Well, we are still considering the EJ to be in a downtrend. This could be a reversal, and we could see price move all the way up here, but our 50 EMA is still trending down. You see that there is price action above this upper edge of our trading field. You can tell that by looking right here. And if you pull up your charts, you'll see the price action beyond that. So we could see price move above this. But in general, the reason that we're considering this to still be in a downtrend is because we have not seen price come back down to this level. Doesn't have to come back down to this level, certainly, but this is where we would be more likely to see a long-term price reversal. So you can see here the overall trend was still down, even though we saw a retracement here. We saw a little bit of a retracement here, saw some consolidation here. We're thinking at this point that this is probably a retracement and that price will continue down to somewhere in this area. And you can see here this most recent monthly candle, which keep in mind is only for a week, as we're just at May 8th. So this is the first full week of May, and we saw price retrace very significantly and move down quite strongly this week. So price is currently midway in between the monthly armpits. We have room for both buys and sells. The preferred direction would probably be a sell because the overall trend is down. But remember, with Forex Pro charts, we use the overall trend direction not to determine whether or not we're going to take a trade, but to determine how we're going to manage that trade and where we want to take limits. And then we also take the trend into account. If a particular trade otherwise has some red flags and it's against the trend, then that may be a factor that causes us to decline to take that trade at that given time. Whereas maybe if we see a couple of red flags but it's with the trend, then we might be more likely to go ahead and take it. But in general, we use when price is in the mid-range like this, we use the trend direction primarily to manage our trades and determine to how far we think price is going to be going. So that pretty much covers everything I want to cover on the monthly. Let's go ahead and take a look at the weekly. Okay, so looking at the weekly chart, you can see here the strong move down that price had last week, and we can see on this chart a little bit more clearly that price actually ran through this support zone, which was new. I think we only put it on the charts last week, so price came up, moved down, and now has almost reached this support zone with the daily armpit at 115.15, I believe. And so this is the zone that we're going to be looking at for some potential trades this week, because obviously price is at the daily armpit. There's a good likelihood that price will move down to the 60-minute armpit. So looking at this particular zone, we look to see the direction on, to see the pattern on the weekly chart. And you can see that this zone does not have the pattern on the weekly chart. This is more a part of an overall uptrend, and so we do not have the pattern on the weekly chart. Do we have ratio? Yes, we do have ratio, reward to risk ratio. Here's the size of our zone, so you're looking at approximately 1, 2, 3, so you can see that price has exceeded, so that we do have more than a 3-to-1 reward to risk ratio, and that's what we're looking for. And you can often eyeball this. Sometimes you'll want to go in and actually figure it out and make sure exactly where your price is, but you can generally see from an eyeball standpoint whether or not price has achieved the ratio. And of course the ratio is their most important indicator, and is the reason you did not see an alert on this zone this past week, because we did not have the 3-to-1 ratio from the origination. Okay, so looking here, we see that we don't see the pattern. Now when we get down here, we do we will see the pattern on the weekly chart. However, you'll notice that origination, 1 revisit, 2 revisit, and price will be coming if price passes through this zone and comes down to here, it will be the 3rd revisit. On the other hand, from here and from here, price has an excellent ratio and has reestablished ratio. So we may, and if we have, depending on exactly the risk, I'm sorry, got somebody out in the garden mowing and my dog is barking. So this looks like a fairly reasonable risk, and we may wish to take that. We'll address that a little bit more when that's closer. We're unlikely to see price move to this level this week. So that is the weekly chart. Okay, so looking at the daily chart, we see similar. We see where price pulled down very strongly last week and moved cleanly through this zone. We're going to look at it on the hourly, but you can see looking here that there is very strong price movement, and that's going to lead you to wonder whether or not we had a bounce off our 60-minute armpit here. Moving down, price has already hit the daily armpit, and I think my armpit got moved a little bit on this chart. I think we're actually looking at 114.93, something like that. Check your analysis. Anyway, right around the 115 area is the daily armpit here, which of course is a strong psychological barrier. And as you can see, we saw the bounce off the daily armpit when price hit, and that is accounted for partially by the armpit and then partially by the 115 psychological barrier. As you come down here, we have about a 40 pip risk on the 60-minute armpit right here. So this is a reasonable risk, and as you can see, we have a pattern here on the daily chart, although it is pretty slight, so we're going to want to be cautious with this trade. This is a fairly new zone. It has achieved the ratio, but it was part of an overall uptrend, and even on the daily chart, the pattern is fairly slight. So we'll want to be a little bit cautious, but the risk is low enough that we can do that. And I'm going to discuss later on this week other ways when you have a zone that you like, but the risk is beyond your tolerance level, or vice versa. You have a zone, the risk may be good, but you're just a little bit shaky about the zone, and you would still like to take the trade. But you don't really want to trade your normal amount of risk. Let's just assume that you're trading a mini lot at approximately $1 a pip, and you don't really want to take quite that much risk by setting up your three portions of your trade in 3 separate lots. What can you do to minimize your risk and still take the trade? So I'll be talking about that. We're going to have a new category on our website. I believe it's going to be called Random Forex Thoughts, and it's going to be just kind of general educational topics, tips, maybe a little bit more elaborate discussion of some particular issue, maybe answer subscriber questions that come up. That'll be no specific times, but just a couple times a week or once a week maybe. We'll be discussing those kinds of things, and that's one of the ones that's going to be coming up fairly early, is other ways to manage your risk. Anyway, so this looks like a good opportunity for a trade a little bit later this week. As I said, we may see price bounce a little bit here off this 115 psychological barrier that coincides with the daily armpit. And then we would expect to see price move down, and we would expect to see it bouncing off of the 60-minute armpit. So this is a trade. We're going to post an alert fairly early, but this is a trade early in the week that you should be watching your charts to see what price action does. If it continues down into the zone, then we'll be seeing a trade on this pair this week. And we have a number of other pair also. The EU, the GU, the EJ, and the GJ are all kind of in similar modes and all coming up to a zone where there's a potential for potential for a trade at the 60-minute armpit, and all of those looked like they could easily be doing that in the first half of the week. So watch your charts, and hopefully we'll see a lot of action this week. Let's go ahead and take a look at the hourly. Okay, so here's our hourly chart, and here is the zone in question that I wanted to talk about. And if you remember, I've mentioned already this zone had not achieved a 3-to-1 ratio, and we looked at it on the weekly and the daily charts, and saw that indeed we had closer to a 1-to-1 ratio on this particular zone, and it was a fairly new zone. And so price came back down to that zone, and sure enough, moved down, spiked through the zone, then it came back up, never did get above the 60-minute armpit, and then moved all the way back down, and now is approaching the zone, this zone here. So here's an example. Now, if you looked at our results video, you saw that we had 2 other trades this week, or 2 other pairs that we did not post trade alerts for, where price hit the 60-minute armpit, and we did not post an alert. And the reason we did not post the alert on the GU and the CAD, I believe were the 2 pair, was because the ratio had not been met. And in both of those for those zones, and in both of those cases, we did see price bounce when it hit the 60-minute armpit. If you had taken those trades, you would indeed have at least major 20 pips, and I think both of them took decent bounces. But here's an example, and as I've told you before and mentioned before, when we see price move through a zone like this, it is almost invariably because the 3-to-1 ratio has not been met yet, and that's why that's our primary odds enhancer. So some people say, well, I'm just going to disregard the odds enhancers and just take every 60-minute armpit that I see. Keep in mind, here, had you done that, you would have had a risk of 40, 50, 60 pips. If you had set put a little cushion beyond that, 60 or 70 pips would have been your risk, which is fairly substantial. And if you had taken this trade and lost on it, then you would have wiped out the gains, the 20 pip gains on 3 other trades. Now, some of those trades might have gone on to gain more, but again, just looking at a reward to risk, that's why we don't recommend just taking willy-nilly every 60-minute armpit, because if you do have a loss, that one loss can wipe out your gains for several other trades if all you get is the 20 pips on them. And so that's going to make it hard for you to keep even. So be very selective about your trades, really minimize your losses, and maximize your gains. And don't worry that you just have 20 pips. If you can get 20 pips and have a very, very high accuracy rate, you're going to be money ahead and be successful. And when you know that you have that consistency, then you can take more lots or increase your lot size and get the money you need. You're not looking at pips. You can always adjust the money you need. You're not looking at the dollars per pip. You can always adjust that. You're looking to make sure what your consistency level is and what your percentage of wins versus percentage of losses is. So I wanted to touch base on that, since I had not included this one in the results video, as I had the CAD and the GU. But here is an example of price moving through the zone that did not have a 3-to-1 ratio and would have been a loss. Okay, so that's it for the week. Thank you for your attention. We ran a little bit long because I talked about some other things. Thanks for your attention. For more information or to subscribe to our full analysis and charting services, please go to our website, www.forexprocharts.com. You can get a week-long demo. You get full access to our analysis on 10 major currency pairs and access to our educational information. Thanks, and have a great day.